Hi, it's Michael King. Today we're going to talk about working capital and cash management. We're going to review the sources and uses of cash for a company, look at 3 tools that are used by the treasurer or CFO to manage their cash, namely the cash budget, the statement of cash flows, and the cash conversion cycle. And we're going to talk about why it's so important for companies to manage their cash, particularly young, fast-growing companies. Lastly, we're going to look at ways that when there is a cash flow gap or a shortage, that the company can finance that gap. Just a moment about terminology. When we talk about cash, we usually know what it means when it's in our pocket. But for a company, there are often cash and cash equivalents, where the equivalents are highly liquid securities that could be converted into cash at short notice. These may be shown as marketable securities on the company's balance sheet. We talk about sources of cash. Those are activities that actually increase cash balances, whereas uses of cash are activities that reduce it. The term working capital refers to both current assets and current liabilities. When we talk about net working capital, we're talking about the difference. Now, a key distinction here for financial analysts is that we're going to take out cash from current assets, because we're going to be looking at that later in our valuation model. And we're going to be taking out short-term debt, meaning debt that's less than 1 year from our current liabilities. So net working capital is going to be non-cash current assets minus non-debt current liabilities. When we talk about the cash conversion cycle, we're talking about how long it takes to convert working capital into cash, which has to do with the amount of time cash is tied up as in inventories or accounts receivable, and the amount of financing that comes from delaying payments through accounts payable. When we look at sources and uses of cash, we can talk about current assets and liabilities as well as long-term assets and how they're financed. So what is the cash budget? Well, it basically looks at activities over the course of a month and what the impact is on cash. So, for example, sales would generally increase cash unless, of course, they are paid for through accounts receivable. In that case, accounts receivable goes up and we do not see the increase in cash until that money is collected. For this reason, high sales could lead to declining cash balances as we have to invest more in accounts receivable as well as inventory to stock the shelves. One way to reduce the burden is to actually take out trade finance by delaying payments and increasing accounts payable. So with the cash budget, we can see over the course of the year, month by month, what is happening with cash balances, where different activities may reduce it or increase cash balances. We can therefore look to see if there is going to be a deficit or a shortage of cash, and we can plan to finance that using a line of credit or other form of borrowing. The statement of cash flows at the end of the year shows what caused the change in cash balances over the course of 12 months. It's divided into 3 parts: the cash from operations, cash from investing, and cash from financing. As the name suggests, cash from operations has to do with sales and the income statement, but it also has to do with working capital. When looking at investing activities, we're talking about cash that's being used up to purchase assets, whether fixed and tangible or intangible assets, or cash that is actually generated by selling those assets. Financing shows how we raise cash by issuing debt and selling equity, or how we use cash by paying off debt or buying back shares. Cash dividends paid out to shareholders is also a use of cash. At the end of the year, we can simply look at starting cash balances, add or subtract cash from operations, investing, and financing, depending on whether they are a source or use, and we will arrive at end cash balances. Let's take a look at Apple's consolidated statements of cash flows. Here, I've split it up into the 3 parts. You can see that Apple started the year with $26 billion of cash. So what happened with operations? Well, Apple was very profitable as seen by net income, which brought in $55 billion. As we can see here from cash from operations, net income was positive and was a source of cash. We can also see changes in non-cash items on the income statement, as well as changes in working capital items, such as current assets or current liabilities. All told, operations generated $69 billion of cash for Apple. When we look at investing activities, we can see that cash was either used up to purchase marketable securities or generated when those securities were sold. Similarly, other assets were either acquired or sold, which was a use or a source of cash. All told, Apple generated close to $46 billion in cash, largely from the sale of marketable securities. Finally, we can look at cash from financing. Here we can see that Apple was repurchasing many of its shares and spent $67 billion to repurchase its own stock in 2019. Apple was also paying down debt, and as a result, cash from financing reduced balances by $91 billion. Now, with those three components, we can see how Apple went from a balance of $26 billion of cash at the start of the year to $50 billion at the end of the year. The combination of cash from operations, investing, and financing led to an increase of $24 billion. Let's talk about the cash conversion cycle, which looks at how cash is used up or generated through working capital. When a company purchases inventory, that inventory is a use of cash. In this case, you can see that a company has, on average, 15 days of inventory at any one time. In this case, you can see the company is collecting from its customers, on average, after 30 days. The combination of investments in inventory and accounts receivable ties up cash for 45 days. One strategy to manage this is to delay paying suppliers by taking out trade credit. In this case, by taking out trade credit for 45 days, the company can offset the cash that is tied up in inventory and accounts receivable, and there is no gap. The three ratios that you'll need in order to determine the days that money is tied up in inventory, receivables, and payables are shown here. You can see that inventory and accounts payable are related to the cost of goods sold, which is the internal cost to the company. Receivables, however, are related to sales. Don't mix up your cost of goods sold and your sales when calculating your days of working capital. The cash conversion cycle typically does not match, so what we see is there's usually a gap. For example, inventory takes 45 days to be sold. Accounts receivable are not collected for another 40 days, tying up cash in total for 85 days. The company pays its suppliers in 30 days, leaving a gap of 55 days. This gap will have to be managed either by having large cash balances at the start of the year or by borrowing or otherwise generating cash to finance the gap. Working capital management is important because even profitable companies with fast-growing sales can almost go bankrupt because they run out of cash. Companies that are particularly at risk have high sales and require heavy investments in both inventory and accounts receivable. So, to manage your working capital, you have to manage not only your balance of cash, but also your working capital and ensure you have short-term financing in place to meet any gaps. Let's take a look at how Apple manages their working capital. As you can see here, we're looking at sales and cost of goods sold from the income statement, accounts receivable, inventories, and accounts payable from the balance sheet. Apple is taking 32 days to collect on sales, an increase over the past 2 years. Apple is only stocking its stores with 9.3 days of inventory, which is a decrease over the past 2 years. What this means is that roughly in about a week and a half, there was no new inventory created, the store shelves would be empty. When it comes to paying its suppliers, Apple relies heavily on trade credit. It is, in 2019, days of payable were 104 days. In particular, Foxconn, who is Apple's supplier of iPhone handsets, has to finance those sales to Apple for 104 days before getting paid. You see that Apple has a negative cash cap of minus 62.9 days. What this means is that Apple is actually using its working capital as a form of borrowing to finance its business. Let's review why inventory management is so important. Obviously, a company cannot make sales unless it does not have inventory to sell to customers. However, having too much inventory ties up cash. So it's a balancing act as to how much inventory to have to meet demands, but how little to have in order to conserve cash. Let's talk about why managing receivables is so important. Being able to offer your customers trade credit is one way that companies can compete and boost sales. That is expensive for the company, however, because you have to finance those accounts receivable while waiting for your customers to pay. Finally, let's talk about why payables are so important. Well, by delaying paying suppliers and using trade credit, a company can finance its accounts receivable and inventory, which will help its shareholders. There is generally a cost for delaying payment once you go over 30, 60, or 90 days, as shown here. So let's look at an example of Home Depot and Lowe's and see who is better at managing their working capital. As you can see, Home Depot has around 82 days of inventory in its stores at any given time, whereas Lowe's has almost 93 days. Home Depot is therefore managing inventory more efficiently. When it comes to receivables, Home Depot is collecting from customers in 6.5 days, or a little less than a week, whereas Lowe's does not offer any credit to its customers and has no receivables. Lowe's is more efficient in managing receivables. When it comes to payables, Home Depot is taking around 38 days to pay its suppliers, whereas Lowe's is taking longer at 48 days. In this case, again, Lowe's is potentially using trade finance more effectively than Home Depot. Summing these up, we see that Home Depot has a gap of 49.7 days that it needs to finance, whereas Lowe's has a smaller gap of 44.5 days. We would say that Lowe's is in a better position at managing its working capital. So when a company has a working capital gap, what are its options? Well, it can decrease inventory, decrease accounts receivable, both of which will increase cash, or it can increase accounts payable, which will also preserve cash. Another solution is to look for alternative ways to raise cash, such as using a line of credit from a bank, which may be called a revolver, issuing commercial paper, or taking out a loan of 2 to 3 years from a bank. When it comes to short-term financing, these are the different options available to a company. The bank line of credit can be organized in advance with a fixed or a floating interest rate and a maximum amount that can be borrowed. There's a charge for arranging a line of credit, but you don't pay interest until you draw down on this line of credit, in which case you pay interest on the outstanding balance.